Ankit, hi, good to have you with us. How have you been?
Namaskara, Ashu from Bangalore. Doing well. How are you? Good to be here.
Doing well, doing well. Ankit, pleasure to have you with us. Excited to host you for an exciting session, right? I think this is a very interesting time, right? I think every discussion with anybody who's on the other side of the table, right? Investing in companies, it's interesting to talk, right? Because there's just so many perspectives, right? While for some investors, it's a funding winter, right? There's a word of caution, right? And nothing wrong with that. I think the global economy is just so much more dynamic right now. We don't really know, what the outcome is going to be, right? But when
Right.
you start talking to investors on early stage investors, right? I think the enthusiasm and the exuberance and the opportunity that India continues to offer, right? For a moment you forget that there is a problem, right? Which is the global ecosystem. So
Believe me,
we're
there is
gonna
a
talk
problem.
we're going to talk about all of that, right? We're going to talk all
Yeah,
about
yeah,
that.
yeah,
But I would
yeah.
love to start this conversation with a quick round of introduction. A little bit of a background about yourself. I think that'll be a good start.
Yeah, I mean, an accidental VC, as I think my introduction pretty much is now templatized or standardized in most of the podcasts that I speak at. But
Right.
yes, I'm an accidental VC. Did my graduation from Michigan, then went on to do my postgrad in SPGN. Uh,
Uh-huh.
Joined the family business. I'm a business graduate, but joined the family business in a highly technical packaging industry,
Right.
where I spent a lot of time on the shop floor. Learned being engineer over there,
Interesting.
and started in 2006. And ours was a company called Manjushri Technopack Limited,
Uh-huh.
which we was Asia's largest packaging company for rigid packaging. So we supplied plastic packaging containers to every brand under the sun, right from Unilever, P&G, Coca-Cola, Bisleri,
Right.
all of these guys.
Wow.
And we had our first private equity infusion in 2014 from Kedara Capital. Built the
Interesting.
business, acquired a company which gave us access to manufacturing plants in the north, and ultimately divested in 2018 to another fund called Advent International at a valuation of $400 million.
Wow.
Took our exit, dabbled in a couple of things, succeeded in a few, failed in a lot more, and then decided that the investment side of thing was my calling. I had started to angel invest in 2018,
Right.
and then obviously one thing led to another, and decided this was my full-time gig. And that's when we brainstormed into what should be our premise of Capital A,
Right.
where I'm a founder and GP. And that's when we realized that there are a lot of early stage appetite for both investment and to invite investments.
Right.
Very thesis driven, very focused approach on a few sectors. And that's when we launched Capital A last year. It's a early early stage fund. Fund one is $25 million.
Right.
Largely focus on the mobility and EV side with focus on fintech. So these two are like the main two key areas where we focus. And then anything enterprise is something that we is right up our alley.
Super. Super. Phenomenal. Again, I'd love to dive deeper into the broader sort of the thesis a little more broadly, right? When you talk of EV, right? EV in itself has many modules available, right? I mean, there's charging infrastructure. There are people who are doing the hardware. There are people who are doing the battery. There are people who are doing battery swaps. When you talk of, for example, and many more, right? In that category. When you talk about
Right.
fintech, fintech again is being cut in many ways, right? I mean, you have B2B. You have lending has been classically there, right? Even in lending, you have many people who are cutting in a different way.
Sure.
Wealth tech, for example, is something which has become just so much more exciting, right? I think India has just woken up to the possibility of investing with ease, right? And I think technology is playing a very critical role in that, right? So I think both of these are very exciting, but very diverse. Would love to understand one, at what stage are you entering of these businesses, and which are the ones which are, say, slightly would be in a sweeter, I wouldn't call a spot, right, but a range, right, that you
Sure.
typically look at and have your bets in that.
I mean, look, coming to your first part of the question, the reason why EV is so attractive is also because the awareness is slowly increasing. The media has started to cover it a lot more. You
Right.
probably will find at least one article every day in every mainline media to which speaks about the policy on EV or plans of many other OEMs like Tata, Mahindra, or international OEMs, what's happening globally. I think the reason why people also are inquisitive to learn about EV is because I think we are perhaps one of the late adapters of this technology. Look, EV and fintech, the similarity between both of these themes is we can't just make a 20-page document and say that here's my thesis on EV and let's start investing.
Right.
Because it's evolving every day.
Right.
There are changes in the cell chemistry, in the battery technology, in the motor systems, in motorless systems.
Right.
There is an enormous amount of evolution happening every day. Similarly, in the fintech space also, fintech is further subdivided into insurance technology, into wealth technology, into lending technology, into payment gateway technology. And there is embedded credit. There is so much more in both of these themes that most of our time is actually getting invested to what are the subsectors in some of these themes, which are the white spaces and which are the ones that we can go after. You spoke about wealth tech, one of the hottest sectors right now. Completely agree with you, Ashu. The reason is because there is a large infusion of retail investors right now who've suddenly woken up to post-pandemic realization that savings, investments are a core part of everyone's lifestyle now.
Right.
And there are two options: the traditional FD system of bank. Obviously, we've completely, I think, outgrown that. Reason being, the inflation itself is almost at par with the interest rates offered by the banks in fixed deposits. Right. Second thing is the current generation of investors are a lot more educated. And that's because folks like you and I have access to technology, we have access to YouTube and a bunch of different frameworks to educate ourselves on what the different investments and what the returns could be.
Right.
The one investment that we did in a company called Giraffe is a complete validation of that theory, that it's an alternate asset class, again, not accessible to retail investors or investors who have an appetite to invest a smaller amount. And that's what they are trying to do. They are fractionalizing or breaking down that amount, usually which would be offered to large HNIs or ultra HNIs or family offices. They've broken down that into 1 lakh minimum or 95,000 for that matter.
Sure.
And with very easy schedules of payout. There are 45 days product, there are 3 months product. So what we've seen is the churn or the shift from mentality that debt and equity are the only asset classes in the investment landscape.
Sure.
With wealth tech coming in of alternate asset classes, and for it to being online and have a very seamless flow right from registering, KYC, online banking, checkout, everything. It's so seamless that it just appeals to the younger generation a lot more.
Sure.
As far as our investment size is concerned, I think the range right now is anything up to $500,000. But we have a very different structure. I think I forgot to mention during my introduction that this fund one is completely proprietary fund, which means I have no external investors. And that gives me a lot of flexibility to construct the portfolio a lot more innovatively. I really don't have to, preference would be to enter as early as possible. But at times when there are opportunities where we have a good exit model, we've also entered at Series A and Series B.
Interesting.
So we do a lot of doubling down. Most of our companies that we invest in, we construct the round in such a way or structure the round in such a way that we budget the next 3-year plan for each investment.
Very interesting. Very interesting. Again, I have a bunch of questions, right? I mean, Giraffe is one company that you kind of highlighted, right? Now, I want to talk a little about the regulatory part of it, right? Because in India, we kind of there are like a bunch of things that are happening currently, right? While of course, startups are disrupting all of what we've built, right? And
Yeah,
essentially,
yeah,
help us solving for the future, right?
right,
Responsibly, more importantly, and with empowerment. I think policy is something which is still kind of catching up, right? Uh, which also brings in an inherent risk when you're investing in some of these assets, right? I'll come to that in just a bit, right? But before that, I want to actually talk to you a little more about the portfolio. When I look at your portfolio and when I look at the construct of your portfolio, right? I think something which is very seemingly exciting is that you have a bunch of investments in the D2C space as well, right? So in a way, the when I look at the portfolio, right, what emerges is that here are a couple of companies that you've invested in the space, right, and then because of the logistical issues, there is another opportunity which is leading into the EV kind of a piece that we just spoke about, right, or packaging for that matter, because that's
right.
what you understand. Right? Is there an interconnectivity between all of this? While it could seem independent, but are you looking at such leverages as well in the process, that continuity in the process?
It's very ironical that we are speaking about this, Ashu, because just a couple of days back, in one of the team meetings, I just told the team that, look, it's okay. One is about early stage funds giving out capital to a bunch of founders, and they're believing in their missions and visions. But the moment you are able to add value, I think that is where this entire investment business becomes a lot more gratifying. When we initially started off, it didn't really seem like we want to have this, leverage of stitching one portfolio company with another. But I think as in how we are progressing with our investment, we are strategically looking more at that. For example, one of our companies that we invested in battery swapping, ChargeUp, right? And they are very large investors in batteries because they have to keep rotating batteries, invest in batteries, keep rotating for swapping them.
Right.
And Giraffe was one of our investments. So we, just sort of stitched both of them together, and we made introduction to the founders. Obviously, everything else was done between them, but just the feeling of both of them coming together and then listing a product on Giraffe's platform was extremely gratifying. Similarly, we have another company called Bamboo, which is into sustainable packaging, right? Biodegradable packaging for many consumer tech companies like Dunzo, Swiggy, Zomato, Myntra, Amazon, Flipkart, bunch of marketplaces. They are one of the largest manufacturers of biodegradable bags. We have another company which is into B2B platform for fresh produce and vegetables.
Interesting.
Right. So, it's a no-brainer, a biodegradable packaging for food packaging, and then, I think it didn't start out that way, but I think the more and more we explore investments, we will see how each of us can, each of the portfolio companies can benefit from someone else's expertise and not reinvent the wheel once again.
So, personally, I think that's a great de-risking strategy if you really ask me, right? I think, I think that brings in a certain sustainability into business, right? I mean, if each business is spending itself, right, and not leverage from the ecosystem that in a way you're kind of creating with this capital, right? I think that's a miss, if you really ask me, right? And I think that's also a reflection of possibly you having done business yourself, right? Having that operator mindset. I think it's a reflection of that as well. We're going to talk about that in a bit, right? But like I said, I want to talk to you a little about the politics, right? Now, there is a lot of this which is happening, right? Like I said, right? There's this EV infrastructure which is sort of coming together. In the fintech space, for example, all of what is, for example, the way lending, for example, has been happening. Now when you look at the policy ecosystem, right, the government is kind of catching up, right? They're trying to, make rules of the game, while the startups already have a certain lead. Now, you as an investor are possibly coming in to the journey when there possibly is a gray area, right? One, I want to understand, how do you address that if there is an element of gray area in a certain business, right? I mean, do you look at an opportunity and does that becomes a priority with the belief that eventually policy will catch up, or do you think clarity in policy becomes very, very important, right? Because my sense is when the policy, so a country like India, right, where there are many, many mouths to, for example, kind of feed and take care of, right? You have to be very careful. Fintech, for example, or wealth tech, for example, right? It starts with a thesis that the retail investor, for example, should not get battered in the process, should not lose capital in the process, right? There's a certain responsibility that kind of comes in, right? Startups are operating at a very different speed. They're kind of, in a way, with technology, they're mechanizing a lot of things, right? Now, with that element, you don't have that required sensitivity. Right? It's a mechanical system that you built. Right? What's your sense of it? Okay, I mean, how do you see this? Are you okay to go in if there is a gray area, depending on the opportunity, or are you somebody who's possibly calibrating his bets, right? With certain percentage in and then waiting for certain clarity to happen, then possibly the next round you come and participate. Where are you on that front? How do you see that?
I think that's a great question, Ashu, because this is something which, as investors, this is a dichotomy that we keep struggling with every day. And I think that is ultimately what early stage investment comes down to, because we still take our bets with portions from different beliefs. So some beliefs can come from the thesis. Some belief will come from historical success of a sector like that. And especially when we are into very policy-heavy sectors like EV and fintech, it becomes extremely important for us to be abreast with happenings on day-to-day basis. Having said that, can we rule out an investment completely because the regulations are uncertain? If the policy is crystal clear, we will not touch it. Right? For example, on the lending side, there was a lot of right now news in terms of how the RBI is designing a framework for the lending companies to work, and a bunch of things that they are correcting. I think when we evaluate these startups, the fundamental thing that we try and see is if the founders are building to get regulated, that becomes a lot more easier to go on to the next step. For folks who say that, look, it's a bit of a gray area and here is our comfort, we do a bit of a risk evaluation. I think, but the former is a lot more easier to do, because RBI is, and I'm sure you already know this, we are one of the world's best regulated markets in terms of both how RBI frames its policies, how the SEBI frames its policies for the entire financial, backbone of the country. And it's a battle neither I want to pick or neither I want my founders to pick. So the preference would definitely be to go into something which is regulated, or they are building to get regulated. Absolutely no qualms about that. As far as EVs are concerned, you must be aware there is a FAME 1 and FAME 2 subsidy policy that exists right now, and we have a lot of articles that we go through every day reading that once the subsidies end, will it still be attractive to the consumers? Answer is a 50-50, because India is a very price sensitive market. And despite many auto companies trying to sell the petrol versus diesel story to consumers and trying to explain the concept of total cost of ownership, let's admit that there is a bit of a heavy competition there. So ICE and EV will have to compete at some level altogether. The good part is most of the OEMs are building for both the sectors. So it's not two completely different companies building for two different sectors altogether. So, there the question comes, whether should we invest in companies which are relying on subsidies. the answer is absolutely no. It's not sustainable. Anyone building for subsidies is going to be affected one day or the other.
Sure.
I think when we look at the 5-year financial modeling, we try and see what is already factored in terms of the subsidy, and thereafter, once the subsidy happens, what's the plan thereafter?
Right.
So these are things that we keep discussing in our boardrooms day in, day out.
That's a difficult one. That's a very difficult one that I can, I think it's very difficult to even fathom, some of this, right? I mean, 5 year, for example, is too long a period, especially what we've seen in the last 2.5 years, right? I think it's unbelievable how markets can kind of play out with one inconsistency, one aberration, right? Again, I'd love to talk to you a little about the macros, right? Now, for any early stage investor today, with what we see in the global markets, right, is not necessarily very conducive, right? The largest boys in the club, the check sizes have shrunk, right? They're not, doling out the money that they want, right? The kind of exuberance that we saw, the excitement that we saw, right? India being the last billion people market, right?
Sure.
Which it still is, right? And a market which is still very cheap in CACs, right? Vis-a-vis all of its global players, right? So it becomes a phenomenal play. There is a certain rub-off, right? We don't have all of these guys, like I said. That exuberance is in a way, there's a slight deferment in that, right? There's a slight delay in that, right? While they still continue to be bullish, the money is taking time to sort of hit the bank, right? In the process, a lot of companies are going through a lot of pain, right? The models will have to be now built differently, right? In how the models were being built, were possibly, and there's a lot of debate which is anyway happening around it, right? There's a lot more caution which is coming, right? How are you looking at this particular thing, right? Because for an early stage, we see, it's basically a buy-in to the next stage, right? It becomes a very, very critical factor of his or her decision making, right? How are you looking at the current status?
In fact, Ashu, every industry has a cycle, and perhaps this entire slowdown in the investment ecosystem, the shrinkage of check size and everything is cyclic in nature. We've seen this happening every 5-7 years. Obviously, this was it's a lot more intense now due to many things that's happening around us. Having said that, the lens, I have a feeling the lens will change permanently. While the quantum of money will continue to remain the same, the lens will change. And what I mean when I say that is, if a company is only torching money to acquire users with absolutely no visibility on how to monetize those users, that'll be a very difficult business to crack. And if that's a business difficult to crack, does it command the valuation, and the quantum of investment of $50, $100 million, $200 million? So I think the lens will definitely change. Unfortunately for us as early stage investors, when we come in super early, I think the hustle and the quality of founders, their domain background, the amount of knowledge that they have on how to build products from ground up, that will become even more a larger factor to consider, given that at such an early stage or MVP stage where they've not even hit a DMF, there doesn't exist any scale or a profitable path at that moment. I think where early stage VCs can help will be definitely to then show them the mirror on how to build a path to profitability with a bunch of stakeholders in the system. Could be advisors, could be domain experts, but I think the lens has changed permanently, Ashu. We can't build to burn. I think we have to build to earn.
Interesting. Ankit, on that point, right? How do you see? Last 2 years have been, transformative, right? We've actually become, as an economy, we've become information first in many ways, right?
Right.
We tend to look up for more information around a certain part, right? But what's also happened is because of this creator economy and just so much of content which is flowing in right cross border without any say for example checks or filters, right? I think the arbitrage that existed in the physical world I think has gone away, right? Now what is also happening is that the preferences are changing very very fast and very quickly of the consumer. And that's brought in a very different kind of executional risk. So while I understand what you're saying, that the cash flow has become a priority, right? In businesses, the fact of the matter is that the consumer preference is something that cannot be calibrated, right? Because the source that it's coming from is completely uncertain, right? You only see a manifestation of that, right? And how it gets perceived could just completely disrupt that visibility that a company could have, right? From a consumption standpoint, right? That's a very different kind of a risk. How do you see that, especially in the consumer ecosystem, right? There could be a product which just becomes irrelevant in a matter of time, possibly a quarter, maybe 2 quarters, right? Because that fad is over. The consumer has now gone into a different fad, right? What's your sense of it? How do you look at that? Is that added to another layer of complexity in the game and making it difficult, right? The revenue visibility. What's your sense?
Definitely, because during the pandemic, there were a lot of edtech companies that came up and built only for the pandemic range of time, and for parents who just didn't know what to do with their kids. They are at home, and might as well give them a screen, and at least they learn something. I think that theory is completely right now redundant. Given people are back to school, kids are back to school with a vengeance, and teachers are back to school.
Right.
So what happens is, in each of these, and any company that had fundamental building blocks only for the pandemic, they have become irrelevant right now. Right. And that's exactly what people are or investors are right now cautioned about. They are very careful about this, that if we are building and if it's for a certain sect of time, irrespective of how much money we spend on acquiring the customers, are we going to do anything about that acquisition? Are we going to do anything about that users that we have amassed? How many of them keep coming back and checking on the product from time to time? So it's a difficult one, Ashu, and you're right, it does add a layer of complexity, because it's a chicken and egg story. If you don't experiment, you will not know consumer behavior, and to know consumer behavior, you have to put something out there. I think the appetite of risk has changed a little bit. So there are smarter ways to do it. I think for folks who said that, look, I'll only be selling online and I will not do offline, I think that clearly needs a shift in strategy. Right. No longer in India can a great brand can only survive online. There has to be a traditional distributor model also, because that gives you reach. And given our disposable income is increasing every day, you never know where a consumer is lying, or a consumer is in Mysore or a Gulbarga in Karnataka, or your customers are only in Bangalore.
Interesting. We're not getting towards the end of our conversation, right? I mean, this has been an absolutely spectacular conversation, and how I want these conversations to go on, right? But I think we have to save for our next conversation, right? But my second last question in this one, right? How difficult is it to maintain that balance? I mean, you've been an operator, right? And once you've been a batsman, I think you're always itching to get back onto that pitch, right? How difficult is that to maintain, and also to invest, right? Because on a and I believe this, right? Classically, I think when you're an entrepreneur, you have that muscle of fool's confidence, right? Is how I look at it, right? You have that optimism where you want to believe things, right? But when you're an investor, right, it's a complete antithesis, right? It's a complete opposite of all of that. Right? How difficult is that to maintain that balance? You've done a large business and a very large one, right? How difficult is this? Or are you like itching to get out of the field? There is a version of you in every business that you invest in.
The great thing about being a VC is that we get the chance to be proxy entrepreneurs in each of our portfolio companies. And while you'll see something happening on the fintech side, and tomorrow you'll perhaps see something on the EV side or something on the creative economy side. So definitely gives you an opportunity to be in the middle of action of many different industries.
Right.
But what really happens is at times, because we are surrounded by stereotypes of running a profitable business, in my earlier stint,
right.
If not immediate profitability, I think that's one question we continue to ask all our pitching portfolio folks, that at least कुछ तो मुनाफा, I mean something मुनाफा का रास्ता क्या है? What's the path to profitability in literal translation? It's difficult, let me tell you that, because maintaining a balance between a founder who says my vision and passion is towards the product and not so much on the numbers right now, but we'll get there. I think the answer of we'll get there is something we keep on double clicking every time when we get that answer.
Right. Interesting. I mean, that point just opens up many more questions, but I'm gonna reserve and save that for our next conversation. Ankit, last question, cliche, right? But I think important. I think you are in a unique position, right? Of having done a business, led a business, currently investing, right? Where do you see that balance, right? If you were to put out an advice to many of these founders who are participating in changing the narrative of the country, right? Changing how the consumer consumes, right? What would that suggestion, advice be that they could possibly imbibe and implement?
I think I'll only speak from whatever experience I've had, and I'm in no position to give advice to the younger generation, because they're surrounded by so much information, so many advisors already. But I think one thing for the founders who are planning to be new founders, I would say that the world of startups, VC, fundraising, coverage of media, and all of that is extremely glamorous, and especially from the outside.
Right.
And that's something which we keep saying to any new founder, whether this is a side gig, are you doing this for peer pressure? Are you doing this only because some of your friends have started up? Because what's really happening is right after college, when they start up, they have two options, whether to get into a full-time job or to start up something. It's always good to have a few years of experience, go through the grind yourself before starting up. We've seen cases where fresh out of college, folks have come out and being successful, but I think the grind sort of helps you get there and get there a little better. The other thing is, you really don't have to be a founder. You can still be a great entrepreneur in your own area of expertise, and you can still call yourself an entrepreneur. So, I mean, suno sabki, karo khud ki. I think that's the single advice that I'd like to give everyone.
Interesting, Ankit. On that note, we'll bring this conversation to a close. But what a spectacular conversation, right? And like I said, there are many more questions that I save for our next conversation, and hopefully soon we'll do this again. But thank you so much for doing this, Ankit. It was a pleasure to have you with us. And I think by no means is investing an easy job, especially in today's time, right? And in today's dynamic market, right? I think it's very difficult on the other side to fathom the complexities that one has to look at, evaluate, right? While they're going out and cutting a check. And especially, to me, what is surprising is this massive dynamism that is coming to the consumer behavior, right? While it's an opportunity, it is a layer of added complexity, right? And that makes the job, I think, difficult for each one of us, but also exciting at the same time, right? It keeps you on the edge. It keeps you agile, which is just so much more thrilling in many ways. Ankit, it was a pleasure to host you with us today. Thank you so much.
Likewise, Ashu.
And look forward to having you.
Terrific to be here.
Thanks.
Likewise. Take care.